Hello, and welcome back to Explain the Charts, your go-to channel for in-depth market analysis. Today is Friday, November 14th, 2025, and we're breaking down the S&P 500 ETF, ticker symbol SPY. The market is on edge right now, with major headlines causing a significant stir. We're seeing widespread concern about a potential bubble in AI stocks, which have been the primary driver of this year's rally. Adding to the anxiety, hawkish comments from Federal Reserve officials are casting serious doubt on the possibility of an interest rate cut in December. This culminated in a sharp tumble for Wall Street yesterday, with the Nasdaq taking a particularly hard hit led by losses in names like Nvidia and Tesla. Futures are pointing to a slightly positive open today, but the question on everyone's mind is whether this is a dead cat bounce or the start of a recovery. To get the full picture, let's start with the daily chart for SPY, looking back over the past year and a half. As you can see, despite some significant bumps along the way, the market has been in a powerful long-term uptrend. After a period of consolidation, the market broke out to new all-time highs in late August. This rally continued strong through September and October, culminating in a peak just under the 689 level on October 28th. Since hitting that high, however, the price action has become choppy and is starting to show signs of weakness. We've seen a series of lower highs over the past couple of weeks, indicating that buying pressure is waning. And then we have yesterday's candle, a very bearish engulfing candle that closed down over 1.2% on high volume. This is a clear signal of institutional selling and directly correlates with the news of rising interest rate fears. The momentum has clearly shifted to the downside in the short term. This price action suggests that the 685 to 689 zone is now a formidable resistance level. Any attempt to rally back to that level will likely be met with significant selling pressure. Before we look at the recent action more closely, I want to highlight a period of extreme volatility we saw earlier this year. Let's zoom in on the first week of April 2025. Look at this series of candles. It's a perfect example of why risk management is so crucial. On April 4th, the market dropped a staggering 3.5%, followed by another sharp drop on the 8th. In just a few sessions, SPY plunged from around 560 all the way down to a low of 481. But what happened next was just as dramatic. On April 9th, we saw an incredible 11% rally in a single day, completely reversing a huge portion of the losses. This highlights that, even in a broader uptrend, corrections can be swift and brutal. It also shows that capitulation events can lead to powerful, V-shaped recoveries. Okay, let's return to the present and switch to the 1-hour chart to get a clearer view of the recent breakdown. Here we can see the battle that took place around the 685 level throughout late October and early November. Each push higher was rejected, forming a clear distribution pattern. The support level was around 675, which held for several days. However, yesterday's news acted as the catalyst to break that support. You can see the sharp acceleration to the downside once the 675 level gave way. The price sliced right through it and didn't find any meaningful support until the 671 area. This shows that the control has firmly shifted from the bulls to the bears on this shorter time frame. Now, drilling down even further to the 15-minute chart gives us a play-by-play of yesterday's sell-off. You can see the market gapped down at the open on November 13th, immediately signaling weakness. There was a weak attempt to rally back towards the gap in the first hour, but it was quickly rejected. From there, it was a steady grind lower for the rest of the session, making consistent lower lows and lower highs. This is classic bearish price action, with sellers in control at every point. The day closed right near the lows, which often suggests follow-through selling is possible for the next session. While futures are slightly green this morning, we are still well below key resistance levels from yesterday's session. All right, let's pull back to the daily chart to recap and discuss what to look for next. The market is at a critical juncture. We have a confirmed short-term downtrend after a major rejection at all-time highs. The fundamental picture is clouded by uncertainty around the Fed's next move and the sustainability of the AI-driven rally. So let's outline the key price levels and potential scenarios. The most critical resistance level to watch is the 685 to 689 zone. A break and hold above this would be extremely bullish, but seems unlikely right now. Near-term resistance now sits at the broken support level around 675, and then yesterday's high around 680. On the downside, initial support is yesterday's low around 670. If that level breaks, the next major support zone is around 661, which was the low from early November. Below that, the 653 level from the October 10th sell-off comes into play. For the bullish scenario, we would need to see SPY reclaim and hold above 675. This would suggest yesterday's drop was a temporary panic, and it could open the door for a move back to 680. I'd place about a 40% probability on this scenario, which would be reinforced by surprisingly good earnings from Nvidia next week or any dovish hints from the Fed. For the bearish scenario, a failure to reclaim 675 and a break below 670 would confirm that a deeper correction is underway. The target would then become the 661 support level and potentially lower. Given the current momentum and negative sentiment, I see a 60% probability of testing these lower levels in the coming days. The key event to watch will be Nvidia's earnings report next week. As a market leader and the face of the AI boom, its results and guidance could either spark a major recovery or pour gasoline on this fire. So keep a close eye on that report and the key price levels we've discussed. And finally, a quick reminder that this video is for informational and educational purposes only. This is not financial advice, and you should always conduct your own research before making any investment decisions. Thanks for watching Explain the Charts, and we'll see you in the next one.